Welcome to Carbon Equity's webinar called Where Investing Matters Most, where we will be getting insights from two top climate fund managers, Rachel Slabo and Cameron McLean. To get started, a few ground rules in terms of what you can expect that we will discuss today. We will not go into details in Carbon Equity's products, our investment offering, or our investment process. For any information on Carbon Equity itself, you can just go to our website. Today, what we will be doing is talking to two leading climate tech investors to get their perspectives on specifically the early growth stage funding gap in climate tech today, which is what they both focus on. In terms of other rules, if you want to introduce yourself, please feel free to do so. We welcome that. So you can write your name and what you're up to in the chat. And if you have any questions throughout the webinar, there should be a Q&A button at the bottom of your Zoom screen. So we will be monitoring that throughout the webinar, and we will hopefully leave some time in the end to answer any audience questions. So that's the way that you can ask us questions. For the agenda, I'll just spend a minute talking about what carbon equity is, so you have some context for those of you who don't know us yet. I will then introduce our two speakers, and we will spend most of the time today in a panel discussion discussing both of our fund managers' strategies, why they both focus on what we call this early growth stage segment of climate tech, or what most people in the industry call the missing middle in climate tech. We'll explain that a bit more. We'll talk about a few of their portfolio companies and their outlook for the coming year. So to kick off with carbon equity, we are a climate investing platform that allows you, or a group of individuals of about 1,100 today, to indirectly invest in the next generation of climate tech unicorns by investing in a fund-of-fund product where we select the top climate venture capital and private equity funds in the world. So that is my role at Carbon Equity. We have a team specialized in fund selection within climate tech. What we do is we build fund-of-fund products that we then offer to our investor base. So our investor base gets to invest alongside these top fund managers and get indirect exposure to hundreds of climate tech companies with one single investment. We are now a community of over 1,100 people, mostly entrepreneurs, executive partners, some family offices, advisors, and we've been deploying close to 300 million euros in climate tech in the past 3.5 years. That is Carbon Equity. Moving on to the more interesting part of today, I'm Carolina. I will be moderating the webinar. I've been with Carbon Equity since inception. I'm part of our investment team. Joining me today is Cameron McLean. Cameron founded and he leads Giant Ventures, a global venture capital firm that backs purpose-driven founders solving the world's biggest challenges. They build and back companies creating more sustainable, healthy, and equitable worlds. Cameron graduated cum laude from Princeton University, and he has an MBA from UCLA Anderson. He spent some time investing in Hummingbird Ventures. He's also built and sold a social analytics company, and he was an early angel investor with some fantastic companies like Uber or Carta. We also have Rachel with us today, Rachel Slabo. She is a partner at DCVC, where she focuses on climate tech investments. DCVC is one of the leading venture capital firms in the world, specializing in deep tech, and they have over $3 billion under management. Before joining DCVC, Rachel was an associate professor of nuclear engineering at UC Berkeley. She also served as a program director at the US Department of Energy's ARPA-E. For those here that don't know ARPA-E, it is a government agency of the US that funds R&D for advanced energy technologies. Rachel, you can let me know if that's correct. And at ARPA-E, she created the nuclear fission program, and she managed the agriculture portfolio as well as the solar and virtual reality teams. She has a master's and a PhD in nuclear engineering and engineering physics from the University of Wisconsin-Madison. Welcome, both of you. I'll now stop sharing my screen so that people can hopefully see the three of us, and we can kick off our conversation. So maybe to start, I of course gave your professional bio, but it would be great to hear a bit more personally about both of you and what led you to become a climate investor. So maybe Rachel, happy to kick off with you. You've been in climate for most of your career, wearing different hats. What led you to your current role as a VC investor?
Yeah, I mean, as you mentioned, my whole career has really been about climate, and from a technical perspective, from a government funding perspective, I also ran an early stage hard tech incubator. And so kind of along that journey, I learned a lot of different pieces. And in the like early 2020s, the ecosystem was really changing in terms of funding availability, policy, regulatory pressure, and there was kind of an explosion of talented entrepreneurs starting climate companies. And so at that time, I concluded that was really where I could go make the biggest difference was to go support those companies to actually get them across the line and have things built and deployed instead of supporting them at the early stages and after a few years being like good luck. um, so it really worked out that because there was so much activity, um, and a real focus on more deeply technical companies joining with my combination of background but from a technical lens, matched DCVC.
Nice. Great to have you. And Cameron, you've been a generalist investor, now founded an impact VC firm. Could you walk us a bit through your journey?
Oh, and thank you so much for having me, Carbon Equity and Carolina. It's been a bit of a winding road for me, I guess. I've done a few things, whether it's build a company or invest early and support other companies. I even had a brief stint as a musician and a composer after Princeton. But I think kind of the core through line for me is I really enjoy building things. I really enjoy channeling creativity, whether it's my own or others, to kind of try and build things that make the world a better place. And I think my kind of core fundamental belief that's developed over the past 15 or 20 years is that entrepreneurship is the most scalable and impactful form of human creativity that exists, and probably the longest lever we have for solving the really important problems that we face. So that's kind of the core belief that's driven most of what I've done for the past decade. And about 5 years ago, I looked around at the world and felt that we were facing quite a few sort of major challenges. I think climate change is the biggest, most hairy problem we face, and thought that perhaps we could play a small role by setting up a firm which really was built from the ground up to back entrepreneurs solving these big problems, particularly climate change. So that's kind of been, how I ended up where I am today. I think I've always been a huge lover of the natural world. I mean, my favorite thing to do in the world is surf. So I get a small bit of satisfaction knowing that I'm maybe doing just that a tiny, 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 tiny bit to try and make the world a better place to live and do something for the environment. But yeah, that's how I kind of ended up in climate tech. And then I think, putting on kind of an investor hat, I see the huge opportunity, right? This transition is happening. There's trillions of dollars that will be lost in the process, trillions of dollars to be made. And I just felt that we could be in a sort of fantastic position to hopefully make a lot of money for our investors and, through the create a lot of value for the companies we back, but really kind of hopefully move the needle a little bit on the net zero challenge.
And at Giant Ventures, you've been running a seed stage fund program for quite a bit now. And then recently you've launched a climate focused growth fund. Could you walk us through what led you to start that second strategy?
Sure. So Giant's thesis is to back purpose-driven founders solving the world's greatest challenges. We invest across a couple of themes from climate to health, but our primary focus is climate. And as you mentioned, back when we started in 2019, we launched with a seed fund, and we're now investing out of our second seed fund, which is $100 million. About 18 months ago, we launched an early growth strategy that was climate only, which is a $150 million fund that we raised to back the 12 to 15 best climate tech companies in Europe and US that were kind of at that moment of inflection to scale up. We raised the fund with the kind of thesis that we felt there was this missing middle, which I think is the sort of major topic of the panel, where there were a lot of great companies that had raised seed or raised Series A, but were looking for growth capital to kind of go to their next stage. And there weren't a lot of great or well-suited investors to kind of partner with the entrepreneurs at that stage. So we felt there was a great moment in time, a great opportunity where we could go partner with those entrepreneurs, help them cross the chasm and have the climate impact at scale that we all want to see, but also get a very good risk reward. We felt that, oftentimes pricing in the private markets is about supply and demand, and we felt there was an undersupply of capital at that stage. So we thought it was a good strategy that would deliver very good returns for our investors.
And of course, the reason we've paired the two of you today is because you focus both on this segment. So, Rachel, it would be great to get your perspective. I mean, DCVC has been investing in climate for decades, but now you also chose to raise a growth fund in this space. So, could you walk us through your thought process there?
Yeah, exactly. So DCVC has been seed and Series A for a long time across a whole collection of sectors, including climate, but also health, biotech, aerospace. It's really the through line that holds the DCVC investments together are, does it have a positive impact on the world? Obviously, can it make money? We're investors. Um, but there's a what we call deep tech. So all of our companies are computationally driven. So there's a sophisticated compute and or data component so that the advantage of the company increases as the company operates. And so before climate was a sector, there were still interesting companies doing climate tech. Um, and that's kind of how we got started. It's been a focus for a long time. And then, as I mentioned, sort of that same conclusion that had me, leave the public sector and come into venture, DCVC had that same observation of there's all this supply of companies. And as Cameron was just saying, a gap. And so that opportunity to really invest at the Series B and Series C when the technology is relatively proven and the companies are past all these seed and Series A funds, but they don't yet have the revenue numbers for the true growth funds to go
Mhm.
plug into their spreadsheets and do their discounted cash flow. There's a real opportunity there and a need. So it's both solving a problem and DCVC concluded the same thing that Cameron did. You can choose the best companies when there aren't that many other people competing with
Mhm.
you to invest.
Yeah.
So the first time I heard of this term, the missing middle, was I think about a year and a half ago from this paper by S2G Ventures of the missing middle. And maybe for our audience who might have not heard the term before, the basic idea is what we've been discussing now, that today's capital markets and climate tech either heavily skew to very early stage funds covering the seed series A, or there's these very late stage multi-billion infrastructure private equity type funds. But that leaves a gap at the middle, at exactly that Series BC stage that we're talking about. And maybe to be so something we hear about or kind of in contrast or giving a different view is there really a lack of growth capital now in climate tech, or is there a lack of quality climate companies at the growth stage? You both chose to raise a fund in this space, but maybe could you give your view, Cameron, on why there are companies there?
Yeah, I think well, obviously we think there is, but and I think yeah, what we've often described, how you describe the kind of growth capital. There's sort of this wall of climate capital from the likes of TPG Rise or KKR that's waiting to write, 50 to $100 million checks. And then there's been a lot of seed funds focused on climate raise, but there is, this gap. I would say that there is quality companies. I think, as always in venture capital, we're looking for the top 1%, right? That is what drives returns in venture. The average does not drive return. So we're always looking for that exceptional entrepreneur and exceptional company, regardless of where we're investing. I think there is a missing middle because I think the amount of seed capital that was raised and deployed at the climate stage was quite significant, which has meant that there have been a lot of companies that have got from seed to Series A and are waiting for Series B checks. Now, not all of those companies are great, and not all of them should raise follow-on capital, but there are some really, really strong ones. And I think we have the luxury of time, as Rachel said at the moment, to kind of really make sure we believe we're picking the best ones. I also think there was a kind of a macro factor at play where the general growth market went through a very challenging time last year. Not just climate focused across the board. It's been very challenging to raise a Series B. So most of the generalist funds are pretty focused on their existing portfolio. Obviously AI has been a kind of sucked a lot of wind out of the room. So I think those two elements together, where there was a bunch of seed capital raised and deployed, there was a challenging kind of macro dynamic for growth, and generalists being focused on kind of their bread and butter, has meant that there's been this huge opportunity. And so I think how we think about it, like DCVC, is we want to go really find the creme de la creme and invest in those. But there's some amazing opportunities out there, and yeah, pretty confident we're seeing them.
And Rachel, why are we talking about this gap now? So when, at least at Fervo Equity, we started investing in climate about 4 years ago. This topic started about 2 years ago, maybe. So was there no gap 4 years ago, or were there no mature climate companies?
But yeah, I think it's a combination of things. There were way fewer mature climate companies 4 years ago. There was a gap, but it wasn't as noticeable because really 2020, 2021 is when that huge infusion of seed and Series A came in. And so it was like 4 years ago was the beginning of a big growth at that early stage in climate. And then there was like no growth in the middle stage in climate. And so the gap was sort of there, but really grew over the last several years. And so now I think it's top of mind because in those intervening couple of years, as Cameron was just saying, those companies that were seed companies 4 years ago are now they're running into that Series B wall where there's still that big funding gap.
And the both of you at your firms, the firms invest more broader than climate, let's say. So do you see this growth stage gap, Rachel, as unique to climate tech, or is this something across other industries as well?
I think it's more intense in climate tech. And there are some sectors where it doesn't really exist at all, like biotech. There's this very clear investment pathway and sort of milestones. And climate doesn't have anything like that. And also, many climate companies have significant hardware components. And so the investment strategy and approach is different from software companies. And a lot of traditional investors really only know how to invest in software companies. And so it's a little bit common to hard tech, but it just seems to be more intense in the climate space.
I think that's a great point, Rachel, where I think the type of manager to try and deploy a kind of early growth or growth stage climate tech fund probably needs to understand traditional growth investing, also be passionate about climate, also probably understand some hard tech, deep tech elements, and that's quite I said, a unique group of skill sets to bring together in one firm or one individual. So I think that's also compounded it. The fact that it is quite this missing middle is more intensely felt in climate tech.
And Cameron, you invest both in hardware and software companies, probably a bit more software than what Rachel would be doing.
Yes, not as deep tech as DC/DC, but we do some.
Are software companies immune to this funding gap?
No, I would say no. I think many of the most exciting opportunities in climate tech are deep tech and hardware, and I think people understand that. So I think they benefit from the ultimate prizes being, really, really considerable. I would say that a fast-growing climate tech software company has probably more funding options than a deep tech or hard tech climate tech company at the scale up, just because if it is very fast growing and it has great momentum and great numbers, all the generalist investors will understand that business and be interested in it. So I would say there is more funding options for software companies if they're doing well, but I wouldn't say they're immune to it. And I think there's probably a bit more competition on the software side. It's easier to kind of create copycats can follow with more rapidity than they can in deep tech and hard tech.
Yeah. And another area where we see a difference in this gap is Europe versus the US. So from our perspective as a fund investor, there is a stronger growth equity ecosystem in the US. Cameron, you invest in both geographies. How do you see the ecosystem shaping up in Europe?
Yeah, I think unfortunately there is more of a gap in Europe still. There's just less growth capital in general. I would say a lot of the growth capital today is US funds with kind of parachute organizations over here in Europe. So unfortunately, the gap is real, just because I think while it's gone much, much better in Europe than I think over the past couple of years than it was sort of a decade prior, it's still an issue, and the capital markets are just way less developed. I think part of the problem is that if you want to IPO, it's just a much better route in the US, and there's just a much more well-trodden path. If you want a liquidity outcome in Europe, it's still probably most likely that you'll be acquired by a private equity firm or an incumbent, and there's not a ton of M&A going on at the moment. So I think that just kind of cools the later stage markets in Europe more than they do in the US. Where I would maybe counter that is that I do think there's more sort of public-private partnership models here in Europe that have worked really well. So the likes of BPI in France, I think, are really active and very willing to sort of unlock private capital with their governmental commitments. Another example is our investor, the Danish Sovereign Wealth Fund, who similarly have a very kind of entrepreneurial and nimble approach to trying to unlock green capital and using the balance sheet to do that. So that's where I think Europe has an edge. And I think Europe also has an edge in kind of a more stable political view towards climate than the US. But if I was looking to raise a growth round as an entrepreneur, I would still rather do it in the US than Europe.
And Rachel, sitting in the US, hearing this, I think you do have some availability to invest globally. So are there any other geographies that you kind of keep track of?
I mean, we try to invest in places where we know the ecosystems and probably have someone who spends time there. So we do invest in Europe, also Australia, New Zealand, occasionally some other places, but and Australia, New Zealand has some similar capital markets features as the Europe, the EU
How do
plus
you do
London.
Australia? How do you do Australia? That's a big time difference. Is someone over there?
Yes, one of our partners lives in New Zealand part-time.
Ah, okay, got it.
Yeah, yep.
Makes
And
sense.
then, but yeah, every now and again, when somebody goes for a board meeting, they kind of do the rounds. You just stay when you go.
Makes sense.
And maybe to start wrapping up our conversation on the missing middle specifically, something that we also hear is if this missing middle is an attractive investment opportunity, you would expect a swath of fund managers to take advantage of it and then the gap to correct itself. Cameron, do you expect this will happen and when?
That would suggest that LPs have a crystal ball and know exactly what to do, which I don't think they do. I think it will correct itself. I think when we see the capital markets hopefully open up in the next 18 months and IPOs come back and people be more risk on, I think it will to some degree correct itself. I think the reason it hasn't is because it's been a challenging market within which to raise any kind of venture fund for most people. And LPs have been a bit risk off given the lack of liquidity. So I think that's why we haven't seen it correct. And then to the point we made earlier, I do think it's a unique skill set required to kind of successfully deploy a fund in climate tech at the missing middle.
Yeah, I would say from an LP perspective, we've been seeing definitely a much larger amount of opportunity and continuity funds, basically early stage fund managers trying to get into the space. So I do think there is the interest from the
It's
fund,
coming. Yeah.
but it's probably the LP side that is still putting the pause. Rachel, you've been investing out of your climate growth fund now for probably about 2 years or so. Have you seen a change in the number of fund managers that are trying to participate in the rounds you look at?
So I feel like it's been a mix of, like, as Cameron was saying, the generalists, like to some extent going home or focusing elsewhere. And so it's stayed kind of even, that there are some groups that have added Series B and Series C with more of a climate focus, but I think it balances the generalist funds who have sort of decided climate is hard or it's not what they care about right now. So it's kind of stayed the same. And it is, I mean, it is a hard, like, again, as Cameron said, it is a hard place to invest because it is this, you need technical expertise, you need commercial expertise, you need to know how to scale it. Like there's a lot that has to come together. And so it's a bit of a tricky, you don't have and you need larger quantums of capital than the smaller rounds, right? So it's just this mix.
And I think a lot of the people who raised, as Rachel said, so the generalists probably have decided maybe it's third on their priority list at the moment. And a lot of the people who raised early stage climate tech funds, often maybe had technical backgrounds as PhDs or came at it more from even an activist perspective sometimes. So maybe just like a different profile than you would usually see on, a growth stage fund. So I think that's also a dynamic.
Yeah. We have quite a few entrepreneurs that usually tune into our webinars. So if you would have any advice to entrepreneurs that are maybe going through this early growth phase at the moment, how do you shape up a Series B today in climate?
Rachel?
Yeah, I guess I'll say what we look for, and different groups have different criteria, is your technology has been developed and demonstrated at a pilot scale, and that means different things for different technologies, but you've shown it basically works. And the thing that you haven't proven yet is that the economics fully work, but you have a sophisticated TEA that shows, okay, everything we've shown so far indicates we're going to hit reasonable and advantaged, unit economics at scale without any miracles. What does that pathway look like? And you have some commercial traction. You probably don't have revenue, or you don't have that much revenue, but you have offtake agreements, or you have contracts, or you have some combination of things showing like, oh, there is product market fit. And so it's really all of that has to come together.
Anything to add, Cameron?
Yeah, on the technical side, when we're looking at deep tech businesses, it would be exactly what Rachel said. So nothing to add there. If it is a software business, I would say you need to show sustainable, strong growth. So underlying growth has to be impressive, but it has to be achieved in a sustainable way. People are not supportive of really high loss-making burns these days. So I'd focus on that, and then you need to have a really unique value proposition that suggests you're going to, over time, be able to capture market share and hopefully secure some increased pricing as well on whatever you're selling. I would say in general, if you're a climate entrepreneur, I'd be creative about your financing sources too. So venture capital, debt, grants, as I said, public-private partnership. There are probably more varied sources of capital for people building climate tech companies. So I think if you look at a lot of the most successful entrepreneurs in climate, they seem to be very able at unlocking those different pools of capital and go out with a decent amount of runway and have as much internal support as possible when you do so.
So to make, oh, go for it, Rachel.
Oh, just something I didn't mention is on the team front, one of the other tricky parts about Series B, Series C is sort of the team is often transitioning from, inventor developer to like you're professionalizing, you're manufacturing, you're scaling. And so does the company know what team they need to build? Have they demonstrated any evidence that they can build that team? You don't have to have that team in place yet, but you need to be showing that you can build it and you know what it looks like.
To make things a bit more concrete for our audience, it would be great to dive deeper into one of your portfolio companies. So I think, Rachel, you should have maybe 7 or so companies in your portfolio by now. Is there one you would like to highlight, walk us through what they're up to, the problem they're addressing, and maybe going back to our conversation, how they've managed through this missing middle?
Yeah, I think, all right, maybe I'll let you choose. Do you want Fervo, the geothermal company, or Radiant, the nuclear fission company?
Um,
Can I chime in too?
Yeah. Yeah.
My vote would be Radiant, but I'm open because I'm excited by that company.
I'm afraid it's actually the one I know less about, so I'll take it as a learning.
Okay, great. So Radiant is a micro reactor company, and I will say, like, being a fission expert is like the least useful skill in venture capital because just so few nuclear companies are good fits for venture capital. But Radiant is one of the few that I think is a really good fit. DCVC had also invested in Oklo, which has exited now. And we got a great return there. But these companies are making very small reactors. So the total amount of capital and the timeline you need to both design, iterate, develop, deploy is so much shorter. So it's really relevant for VC. So Radiant is making a reactor that the whole thing can fit in a shipping container, like the reactor, the power conversion system, the whole thing. And so its market is remote communities and specific industrial applications. And so we've seen that as a real area of interest where basically right now the choice is diesel generators. And diesel is expensive. Its price can be variable. Diesel generators are gross, right? They're smelly, they're loud, they make ground level air pollution. And for a lot of these remote areas, the logistics of getting diesel there is quite complicated. And things like military bases, it can be quite dangerous to get diesel fuel there. Places like Alaska and northern Canada, sometimes the roads are made out of snow and those roads don't exist for as much of the year anymore. So there's like real complexity in some of these areas. And so instead of dealing with diesel fuel, you get a microreactor delivered and it lasts for 5 years. And every 5 years you can get it refueled for, we expect it to be longer, but we're initially a 20-year lifetime. And so it's just cleaner, more reliable. The logistics are easier. And Radiant, the reason that we chose them and think they're so great, the founders came out of SpaceX. And so they've designed and built real things before. The CEO built the Grasshopper rocket, the one that landed itself before we had the chopstick approach. And they were bringing all of the sort of cutting edge design and development tools. So, like digital twins, um, data driven hardware development. So, they've been incredibly efficient. They have, since the inception of the company, stayed on track for their demonstration timeline of 2026. And that is just not something we see very much.
And from a fundraising perspective that we've talked about, have they struggled trying to raise? What stage are they in? And maybe could you walk us through the last round they had to raise and how that went?
Yeah, I realized I am saying this and the news goes out tomorrow, but so there will be some news tomorrow about their latest round. Um,
Well,
they surprisingly have not had trouble raising. Um, and I think just the compelling team and the compelling vision and the clear product market fit. They've gotten a lot of commercial contracts at this point, but Union Square Ventures led their Series A, and DCVC participated. A16Z led their Series B. Um, they've really done quite well on fundraising
wow.
and been capital efficient. They also just haven't needed that much money, even compared to a lot of other climate companies.
Something we obviously hear more in the climate tech space, raising the Series B, is also the importance of offtake agreements when you're trying to build a
Mhm.
facility. How has that been for Radiant? Did they have to lock in those agreements to be able to raise the current round?
Yeah, they did. And so it, they, they expect first product deployment in 2028. So it was a little, uh, to some extent, we thought, well, how firm of agreements can you get? But they're actually getting customers to pay deposit.
Wow. And maybe I should take a step back. Could you, Rachel, walk us through as a deep tech investor yourself, the importance of offtake agreements, what that means, and what you look for in the kind of companies you invest in?
Yeah, and it varies a lot by technology type. So an offtake agreement is a commitment to purchase a product in the future with some set of parameters. So ones that we're really used to thinking about now are power purchase agreements, right? So when you start developing a clean energy project, there's a commitment to purchase the power at a price for a certain period of time. So with Fervo, power purchase agreements is the form of Fervo's our geothermal company. That's the form of offtake they're getting. Radiant is selling the actual units, so it's a commitment to purchase the units.
Yeah, great. And Cameron, moving on to your portfolio, I think you have probably about 5 companies in the growth portfolio now. Is there
Yeah.
similar one you'd like to highlight and walk us through?
I'm happy to do flower or greener. Any other preference?
Rachel, I think you get to choose. Do you know
Oh,
the companies?
geez.
Or
We
should
can
I?
do flower. We can do flower.
Okay. Okay.
Uh, so take a slightly different flavor for the people on the call than what Rachel described. So this is a company called Flower, which recently raised and announced a $50 million Series B, Series A, Series B led by Northzone, which we were a significant participant in. The company was founded in 2019 by an entrepreneur called John Dicklev, who actually founded it straight out of university. His master's thesis was on kind of the energy flexibility problem in Europe, and that founded the basis for his work. So he's one of those not college dropout, but straight out of college, starts building the business, and it's going very, very well. And what Flower does is essentially it provides flexible power. That's probably the simplest description of what they do. So Flower makes sure that power is delivered to the grid when and where it is needed. And they achieve this with machine learning software that optimizes renewable energy generation and storage assets across Europe, and also by developing grid scale batteries and energy storage systems. So this is an important problem to solve across the world, but particularly in Europe, I would say at the moment, because the grid is quite fragile. There's two kind of key factors contributing to the fragility of the grid at the moment. The first is unpredictable energy supply. Obviously, the Russian-Ukraine war did not help with that, and then unpredictable energy supply because we have more electrified assets now that are connected to the grid. So obviously, solar and wind and what have you are not as predictable as traditional hydrocarbon energy generation. So Flower's built a world-class machine learning software for managing these energy assets, and they're generating tens of millions of revenue at this point. Their optimization software is pretty crucial for a well-functioning grid. Since the intermittency and the many endpoint energy assets comes with a lot of operational complexities, and the batteries that they are developing is also pretty crucial. So it's kind of a unique take. We took the view that we really liked this kind of vertically integrated model that they were going with. They started out with software that was doing aggregation of these distributed energy resources and optimization of the grid, and then also trading kind of the imbalances in the grid. That was how they started. But then they took a view that to really accelerate their expansion across Europe, that they should start potentially developing and owning their own battery assets as well. So they're doing that. They've now developed a portfolio of grid scale battery projects. The largest is a 42.5 megawatt facility in Sweden, which they acquired in April of last year. So it's a true vertically integrated kind of model. Our thesis that we underwrote was, if you can get multi asset, multi-geo, multimodal as quickly as possible, you will have the most data inputs of anyone kind of trying to balance the grid, and that should give you a real edge in your algorithms for balancing, for trading, and therefore the value you're providing to the customers and to the grid. So that's where they are today. We have aggressive expansion plans for next year, which we're excited about. And yeah, it was the most recent investment we made from the fund. So I always love the most recent investment that I made. So I'm very excited about this one.
Nice. And Rachel, of course, I know you have a company in a similar space based in the US, Equilibrium. Could you share with us your thesis there? How does the grid balancing problem differ in the US versus what Cameron shared here in Europe?
Yeah, I mean, every electricity market is its own special snowflake, and the US has really made them complicated in some areas. And so, yeah, it's funny. All of Cameron's thesis really is similar to Equilibrium, and it's just the details of implementation are a little bit different. So Equilibrium Energy is at their core, it's a digital twin of the grid. And so you need to be able to model. So you need so much data. It's like transmission, what are the generation assets? What are the load assets? What's the weather going to be? And understanding how the bidding and transaction works in that specific electrical market. And so in the US, it's regionally different. And so Equilibrium started with doing virtuals trading because it basically proves out the fundamental system. And that's virtuals trading is basically a time arbitrage of electricity. And if you can do that and prove that you can make money in it, then you have the infrastructure to trade batteries as well. So they provide a tolling agreement to battery owners. So they don't own the asset, but they operate the asset. And for battery developers, it's actually quite difficult to make money on batteries. So having a tolling agreement that provides a fixed payment helps them go get a loan so that they can do their financial planning. It's much simpler for them. Radiant then goes and trades those batteries for the upside, but maybe some additional complexities of the US market. In different markets, you can get paid for different services. So right now, batteries make a lot of money on what are called ancillary services, and that's providing basically like frequency regulation and stabilization for the grid. But you only need so much of that. So as that ancillary services market saturates because of battery availability, it becomes even more important that you can make money by trading. And so we think the demand for Equilibrium surges even further after ancillary services saturates. And part of why we think it's so important is we're concerned that if people can't make money as easily on batteries, they'll stop building them. So you really need something like Equilibrium to continue that deployment to ensure that people can actually monetize these assets.
Two great funds coming to the same conclusion.
Yeah.
I love it.
Same
Maybe
thesis.
we have LP bias going on.
And potentially one interesting thing in Europe, I'm not sure it's the same in the US, that you can do with that data is potentially match supply and demand, right? Via PPAs, and also map out where the new renewable infrastructure should be built out. So that's another exciting expansion area potential.
Yeah, or being able to provide energy packages to groups sort of making sure that the clean energy matches their demand. And, there's a lot of stuff you can do if you actually have these models right.
Now, the three companies we've talked about are more on maybe the capital efficient sides, and they seem to have been successful in raising funding. Rachel, maybe I'll take you up on discussing Fervo very briefly, because that's obviously an example of a very capital intensive company. And could you walk us through how they've had to build their capital stack to be able to build geothermal projects?
Yeah, and just really quickly, Fervo is applying horizontal drilling and fracking developed in oil and gas to geothermal, which historically has not been very predictable that you can actually get the power out. And so they're really changing it so that geothermal is now a predictable resource with their modeling and applied technology. But it's really expensive to drill holes in the ground. And so they've needed quite a bit of money. And so it started with equity totally to build their very first plant. It was just equity. And now they've been able to get some grant money, but they're starting to get loans, like just a loan from the bank. Um, they're about to sign an agreement for letters of credit, and they're negotiating term sheets for project finance. And so it's when you're building a business like this, I think one of the mistakes that people talk about a lot from Climate 1.0, or back when it was called Clean Tech, was people were really building everything on equity, and you just can't get venture returns off of like infrastructure investment. They're just not the same thing. And so a lot of the focus now has been accessing debt, accessing project finance, accessing recoverable grants, just like all these different types of capital. And so that's, the evolution of these companies goes from can we show that we can build it to like we really have complex financing mechanisms, and we spend a lot of time on that.
Great. I think I'll move on to outlook for the next year. But thanks so much for those examples. Always good to make things, yeah, through technology it becomes more real. What we were talking about before. I've already seen in the Q&A that we've started getting questions about this. So, Rachel, I have to ask. Last week there were important and disappointing news for some of us in the US. From, of course, I'm talking about Trump winning the presidency and gaining control of the Senate and likely the House. This morning, I actually read a piece from your colleague Milo on this topic, which I think is actually one of the better ones I've read in the last week, essentially saying that in the absence of government support, we will just need to create a new financial framework that is capitalist and return-driven to achieve the industrial transformation of climate tech that we have upon us. What is your view on the effect of the next administration for the types of companies you invest in?
Yeah, I mean, I think there's a lot that we don't know because so many things might happen. But I think there are some technologies that, the government doesn't control everything. There are technologies that already have a really strong commercial pull. Like Fervo is actually a really good example. That demand for clean, firm power is so strong that we expect, the Fervos of the world to continue to be able to scale because they are making a cost-effective product that provides good returns for a thing that people really want. And that's, I mean, when we made our investments originally, we were looking for companies that would be on that path. And I think the challenge with removing some of the government support is that could fill some of those gaps until they got to scale. And I think there are questions about how those gaps become filled for the technologies that are still in, those slightly earlier stage technologies. And I think there's still a lot of demand for many of these sectors where the value is really durable and clear.
Cameron, you of course invest in the US and Europe. Do the elections change your view on where it's more attractive to invest right now?
Oh, I think to Rachel's point, we kind of have to wait and see. It's as an unpredictable man in the White House, so hard to know what he's actually going to do. But I would say that it does, tilt tilted towards Europe in my view. I don't think he'll repeal the IRA, but he could now with the House and the Senate, which I always thought was very unlikely. So it's possible, but it is creating a lot of jobs in red states. So he might not. But I do think just the uncertainty will be challenging. I think it's hard to know what he's going to do with the tariffs and how that's going to kind of knock on to all the kind of climate tech companies trying to build built in the USA. Really hard to predict, but I would say the uncertainty makes it a little harder to underwrite. And I would say consumer companies or consumer facing companies that were reliant on IRA credits of some sorts might face a tougher road ahead.
Yeah, and maybe just to double
not
down.
just consumer, B2B as well. Sorry, go ahead.
Oh yeah, but the tariffs are such an interesting example of it may really mess
Yeah.
up the cost value for some companies, but it may really be a driver for other companies.
Mm-hmm.
But I would say some of the things we've been seeing are bigger corporations that the Trump administration might listen to pushing for consistency. Right. So yesterday, Exxon CEO encouraged the Trump administration to remain in the Paris Climate Accords. Not long ago, a collection of oil and gas companies encouraged the Trump administration to keep the IRA. Right. I think there's, for a lot of these companies, they are investing in the future and they need to know what the path looks like and they need it to be stable. So I think we're going to see maybe more than we were expecting. Corporations that Republicans would listen to push for stability.
I think the damage will probably be more around the lack of global leadership and the uncertainty around that. I think that'll be the real long-lasting damage, unfortunately.
Yeah. It's not, we are not happy. We're just trying to look for silver linings anywhere we can.
Yeah.
Okay, I'll not take you through the pain of talking about the US elections more. So let's wrap that part up. Maybe shifting gears, we're almost done with 2024, and I think for carbon equity, we of course sit at a bit of a higher level, but this year we've seen a lot of things happening in grid flexibility. We talked about that already.
Yes.
The whole AI boom, not just AI applications in climate tech like materials discovery, but also power efficiency in data centers, compute. I think that's been one of probably the topics of the year that we've perceived. Are there any sectors or technologies that you're tracking or excited about for the coming year? Maybe Cameron, I'll start with you.
Yeah, my number one was data center decarbonization is probably the trend we've spent the most time at. There's a lot of ways to break that down, right? From the very base chip level up to kind of more software optimization stuff, to big data Snowflake type software packages that actually allow for much less compute for kind of the approaches they take. So there's a lot of ways to play that trend. We've actually got an investment in a company called EVROC that's soon to be announced, which wants to build European sovereign sustainable data centers, which I think just got a big push from Mr. Trump. Their first data center will be launching again in Sweden, leveraging hydroelectric power. So it's an area we're really excited about. Looking, I think, to play it in multiple different ways, both from our seed fund and our growth fund. And I think the big kind of question we'll always ask is like, where is this venture scale? Does this have venture dynamics? So yeah, I think another area we're pretty excited about, and maybe doesn't get enough attention because it's kind of an established technology, but the rollout of solar continues to be pretty astounding, I would say. There's now more solar in Texas than California, and almost 600 gigawatts is added globally. So it's up around 30% versus 2023. So it's pretty impressive numbers. So we've recently invested in a company that's doing robotics automation for solar installation. So I think that some enabling technologies kind of really helping the rollout of solar, particularly given we're going to have labor shortages in the US, given what again the president plans to do. I think is an exciting area to invest behind. More broadly speaking, obviously focusing on data center efficiency and decarbonization is interesting, but I think AI can drive efficiencies across industrials and manufacturing, reducing waste and energy usage in that process. So that's another area we've spent some time on. So on the positive, I would say those are a couple areas we're excited about. Nuclear's obviously gone a huge push, and we've been excited about internally, but I dare not talk about that one with Rachel on the panel. So
It's really weird to be in a sector for 20 years and then all of a sudden everyone else is like, oh yeah, we agree with you now.
Great, I've been waiting here. Yeah. Rachel, anything to add there? Other sectors, trends that you're seeing in the tech space?
No, I mean, I think those are a lot of the ones that we're thinking about. Maybe one that is not as much of a, I don't know that next year's going to be a big uptake, but I think is going to see a stable growth is insurance and ways that we can use insurance both as a financial tool, but as a concern in and of itself, as we just increasingly see disruptions from climate change. You know, we had that horrible flooding in Valencia quite recently. The East Coast is on fire in the US again in a way that is not normal. Like, I think we're just going to see more. I expect just insurance instruments. And there are some real complexities in both the resources you need and the models you use. So
Have you
that's
spoken
the
to
one
our
I would add.
portfolio? Have you spoken to our portfolio company, Arbol?
Maybe I haven't, but maybe.
ARBOL. Okay. Well,
Okay,
they're doing parametric insurance for climate risk, and they're doing very well. So
great. I will talk. Let's
let's
connect
talk
after.
about it afterwards. Yeah.
Nice. Great. Well, maybe we should we have like 7 minutes left. I'll turn to the audience questions, see if there's anything that we can pick up there. Actually have my colleague Itz on the line. So Itz, is there anything that caught your interest?
Yeah, sure. I have one question. I think that ties predominantly back to the discussion surrounding if you would rather want to raise a growth round in the US or in Europe. And this question is from Edward. He asks, how do you look at the difference in cost of skilled labor between the US and the EU? And shouldn't that provide a significant upside to the companies in Europe? So I think this one was directed to you, Cameron.
I think because the cost of labor in Europe's significantly lower.
Yeah.
Yeah, I mean, I think we do take that into account, particularly if the technology team is being built somewhere in Europe and there's some sort of strategic asset that they're kind of maybe some university or something that they're tied to. That definitely helps. What can be challenging is I think there's maybe less established business talent in Europe that have seen scale ups go from 100 million to a billion to 10 billion. And it is a less flexible labor market in Europe as well, which can also be tough for startups. But overall, I think the technical talent actually in Europe, in my not super qualified opinion, is better and definitely more affordable.
And one more question from Wim. He says there's never been more capital around in the system, so there must be reasons why that capital cannot find its way to the Series B and C rounds. What for you is the key aspect you think that is missing at the company level to make the money actually flow to these companies?
I think part of it is, again, it's been spoken about a lot, but I think part of it is that the finance stack is being built out, but needs to continue to further develop. And there is a bit of a mismatch sometimes between the infrastructure type capital needed for climate tech companies at Series B, Series C, and the kind of and venture capital, which is an equity style investment with very high return expectations. So I do think there's a real opportunity for a manager to take advantage of that. And I think over time, someone will do it and someone will do it very, very well. But it just requires, I think, time for that to happen. And then I think some of the companies should not be backed by venture companies, which I know is a little controversial, venture funds, but you don't want to repeat the mistakes of clean tech 1.0. And some of those companies are better suited to other forms of financing. I hope they do get financed, but I also think some people have made some tactical or strategic errors in some of the companies they've chosen to fund.
And maybe to add on to that, I think what the companies can do is that real focus on quality, unit economics, team building, and plan. And I do think actually, Cameron, I guess we agree on most things here. That I wish the ecosystem actually had more conversations about what are the tools we should be using to build climate companies that isn't just venture capital, because not all of these companies can scale at that rate. Not all of them can provide the returns that you would need in a venture portfolio. So I think there is some, using this tool for the wrong thing. And we need more tools because those problems are real and they need to be solved.
I think that's a nice wrap up, Taro.
Great. Well, thanks a lot, Rachel and Cameron, for joining us. To the audience, I actually wasn't explicit about this, but at Carbon Equity, we deploy fund of funds, as I mentioned at the top, and both Rachel's fund and Cameron's fund, their climate growth funds, are part of our current fund of fund program, which is still live. We're still fundraising for it. So if their insights pique your interest and you'd like to learn more, you can definitely go to our website, and you can indirectly gain some exposure to the companies that we talked about today. So with that, thanks everybody for joining us. Thanks again, Rachel and Cameron. Really liked the discussion today. Maybe not the most controversial panel, but really enjoyed
I
it.
know. Next time, Cameron, we have to figure out how to be more spicy.
Well, this is what we disagree on. Yeah, nuclear is a terrible idea. Thank you so much.
Yeah, thank
Cheers.
you. Really appreciate it.
Thanks, everyone.
Bye.
Bye.